1 or 2 weeks ago, a buddy of mine approached me. He wanted to thank me because I introduced him to a company by the name of Ammo Inc., ticker POWW. You see, he had made quite a bit, roughly 25 to 28% on that play, and he wanted to thank me for it. Naturally, he was curious as to what I was doing with my shares, and I told him I haven't sold yet. And he says, "What do you mean you haven't sold yet? It dumped immediately after earnings." I said, "Well, yeah, that's all right. I think that the fundamentals, the financials, the economic conditions all support this company going higher over time under normal economic circumstances." He says, "Yeah, but you're tying up all this money in this stock, and it's going nowhere. It's just going up and down, up and down." I said, "Well, no, wait a minute. I'm making money on this stock." He's like, how in God's name are you making money on this stock?" And I told him, "Well, I'm selling calls." Like, "You're selling calls? Wait a minute, the price is going down. You're losing money on your calls." I said, "No, no. You don't understand. I am selling calls. I want the price to go down. I want them to expire worthless. I want to collect that premium and reinvest it back into my Ammo Inc. position." And then he kind of looked at me with a funny face, and it turned into a long conversation about covered calls and later cash secured puts. And that was a conversation that I didn't particularly want to have again. It's just too much, and I hate typing up lengthy stuff that people can't properly digest in one sitting. And so I figured I'd make a video about covered calls and cash secured puts, which brings us to today. And with that said, my name is Chris. Welcome to Stock Tips, and I hope you enjoy the video. All right, for any of you out there who know me, you know my style. You know what I look for when I'm looking to invest in a company. I'm looking for historically profitable companies trading at a sector or industry relative value on a pullback of little to no negative consequence, favored by institutional investors, and all under favorable economic conditions. Generally, if I can somewhat meet all of these criteria, I understand I got a solid pick here. And that's why I like the company Ammo Inc. I think it meets all these criteria. I'm not going to go into too much detail, but I do understand that this company is going to take some time for the market to digest, evaluate, and allow those financials to catch up and surpass current share price. So that's why I think the covered call strategy is a perfect option for this particular stock. The idea being is I can sell calls at a strike that I am perfectly willing to lose my shares for. Remember that when you sell a call, you're giving the holder of that call the right, but not the obligation, to purchase those shares away from you at the strike. And if it doesn't hit the strike price by expiration, I will be able to keep the premium that the call holder paid to take out that call. And then I'll take that money and reinvest it right back in to the company that I'm invested in, enabling me to effectively make more money in the long run off the same position with more shares. All right, let's start with the POWW 17 December 2021 covered calls. The share price is trading at roughly $6.30. You will need to buy 100 of them in order to establish a covered call position, which will cost you $630. Now, your broker is not going to allow you to sell naked calls onto the open market, and there's good reason for this. Theoretically, a share price can go up forever. And if you have to purchase shares out of the market to cover a call, there's a good chance that you might not be able to afford it, and you'll be margin called. And then your broker has to cover the cost of that. However, your broker is perfectly willing to allow you to sell as many covered calls as you want into the open market, pending that you own enough shares to cover those covered calls, should they be called away from you upon assignment. Now, the call premium on the POWW 17 December 2021 calls is roughly 15 cents. When multiplied times 100 is $15. Remember that when you're dealing with call premium, you multiply it by 100 because we are representing 100 shares. And that's roughly 2.38% of the overall position. Now, this might not seem much. However, to give you some perspective, let's assume that the price stayed at $6.30 and went nowhere throughout the year. It didn't go up, didn't go down, it stayed at $6.30. And you continuously collected that 15-cent, 2.38% of your position premium. By the end of the year, that would amount to roughly 28.57%, which usually can beat the S&P. And yet there are other benefits to selling covered calls. Remember that 15-cent premium that you received? Well, that lowers your cost basis to $6.15. That's your break even. Whereas earlier, you needed the price to dip below $6.30 for you to lose money on the position. So as long as the price stays above $6.15 at expiry, you make money on that position. And even if the price is below $6.15 by expiration, big deal, you're still bullish on the stock, and you can sell the following month's call all the same. Now, there are some limitations in the covered call strategy, in that it caps your profit. In this scenario, we bought the shares for $6.30 and sold the 7.5 December strike for 15 cents. What this means is if the share price is above $7.50 by contract expiration on that 7.5 strike call, we will get assigned and lose our shares for $7.50 per share plus the 15-cent premium, which comes to a real price to us as if we sold for $7.65. Of course, $7.65 minus $6.30, the price at which we bought in, equals $1.35, which is the max profit we can make. Now, a 21% profit isn't bad, but as call option sellers, we must come to grips that if the share price skyrockets to $10 per share, the most we can make is $1.35 per share. Now, our max loss is theoretically $6.15. I say theoretically because the company could go bankrupt and the shares can go down to zero. And so therefore, $6.15 is the max we can lose. But we bought the shares for $6.30. Why only $6.15? Because remember, you still sold that call for that 15 cents. You're going to get that premium no matter what. Now, don't pay attention to that premium. That premium can change month to month. I've seen it as high as 40 or 50 cents and as low as 10 cents on the monthly. Honestly, it all depends on when that contract expires, how soon that contract expires rather, and at what price the shares are at any given time. Remember that probability drives what premium those contracts are going for. Also, I think there's something to be said about premium chasing. Some people wait for that share price to increase because they're chasing that premium. They want to sell those calls for that beefed up premium, and quite often it never happens. They're chasing for that increased share price, but they never really get the premium that they want because either the share price declined or time decay set in, and so on and so forth. In cases like these, I think it's best to be safe than sorry and sell for the premium that you can get. In addition to that, we got to think about how funky your portfolio is going to look. If you sell calls against the underlying, then all of a sudden the price skyrockets temporarily. Yeah, it'll be negative. The options will be negative in your portfolio at least, but in the end it'll all even out to the to what you expect to get by expiration. Finally, let's talk about keeping your shares when you're about to be assigned. A lot of people sell calls with no intention of ever losing them. And it happens. You know, the share price suddenly spikes, and all of a sudden, you're about to be assigned. There is a way for you to keep your shares, but there are some nuances to it. I mean, you can roll the calls that you sold by simply buying back the call and then selling a month further out. However, there are some issues with this, and I would highly recommend that if you do this, you wait till the call is about to expire. That way, at least, the call is tracking one-to-one with the share price as close as you're going to be able to get it before you buy it back. The FAR month should be higher than the one that you are currently selling right now, and you should be able to walk away and keep your shares and still somewhat make a profit all the same. Anyway, that's all I have for you. I know a lot of my subscribers already know how to implement this strategy. However, I was getting a lot of questions and figured I'd make a video on it. Now, for you folks who think that playing with options is going to blow up your account, this is not one of those option strategies. For you new guys, so as long as you sell at a strike above your break-even point, you're at least not going to lose money on the option itself. You might lose money on the shares as they decline in value, but at the end of the day, you're going to collect that premium no matter where that strike price is, or where the share price is rather, by expiration. Anyway, I hope you found this useful. I hope you enjoyed it. Please do not forget to hit that like button, and if you're new to the Stock Tips family, don't forget to subscribe as a free subscriber in the link below. Thank you for your time and thanks for listening. God bless and safe trading.